A buyer can say they are serious about a home, but sellers usually want more than words. Earnest money is the deposit that shows the buyer has real skin in the deal. It is not an extra fee for the seller. It is money placed at risk while the purchase moves through inspections, financing, and closing. The contract matters when financing contingency explains why two similar situations can lead to different outcomes. This becomes concrete when the inspection deadline protects the deposit. Earnest money is usually paid soon after the purchase contract is signed. The amount depends on local practice, property price, competition, and negotiation. In a calm market, it may be modest. In a competitive market, a larger deposit can make an offer look stronger. The escrow holder matters because the deposit should sit with a neutral party, not casually move between buyer and seller. A useful sign is that wire instructions should be verified before money moves. The money is normally held by a neutral party such as an escrow company, title company, broker, or attorney. That matters because the seller should not simply pocket the deposit on day one. The money sits aside until the contract either closes or ends under the rules both sides accepted. For example, wire instructions shows why the small print, body signal, deadline, or incentive cannot be skipped. If the sale closes, earnest money is usually credited toward the buyer's closing costs or down payment. A buyer who deposits $5,000 may see that amount applied on the final settlement statement. It becomes part of the purchase funds rather than a separate cost. A financing contingency can protect the buyer if the loan falls through despite a serious attempt to qualify. The risk appears if the buyer breaks the contract without a protected reason. If someone changes their mind after all deadlines have passed, the seller may be entitled to keep the deposit. The logic is that the seller took the home off the market and may have lost other opportunities. Inspection deadlines matter because the buyer may need to cancel within a narrow window to protect the deposit. Contingencies are the buyer's main protection. An inspection contingency may allow the buyer to cancel if serious defects appear. A financing contingency may protect the buyer if the loan is not approved despite good faith effort. An appraisal contingency may help if the home appraises below the contract price. The closing statement shows where the deposit goes and how it affects the final amount due. Deadlines are crucial. A buyer may have the right to inspect, but only for a certain number of days. Missing that deadline can change the deposit risk dramatically. Earnest money problems often come from calendar mistakes rather than dramatic disputes. This matters because seller confidence shows why the small print, body signal, deadline, or incentive cannot be skipped. Imagine a buyer discovers major foundation damage during inspection. If the contract allows cancellation during the inspection period, the buyer may recover the earnest money. If the buyer waits until after the deadline and then tries to cancel, the same defect can become a much harder argument. A contract default is serious because it can decide whether the deposit is returned, disputed, or kept by the seller. Sellers care about earnest money because it signals commitment. Accepting an offer means saying no to other buyers for a while. A weak deposit may make the seller worry the buyer will disappear easily. A stronger deposit can reassure the seller that the buyer will take deadlines and financing seriously. The risk becomes clearer when inspection deadline explains why two similar situations can lead to different outcomes. Buyers should not use earnest money to show off unless they understand the risk. A large deposit can help win a bidding situation, but it also increases the amount exposed if the buyer ignores contract terms. Strong offers should be confident, not careless. The inspection deadline matters because a buyer may lose protection by waiting too long to raise a problem. Disputes happen when both sides claim the deposit. The buyer may say a contingency allowed cancellation. The seller may say the buyer defaulted. Escrow holders usually will not release disputed funds casually. They may require written agreement, mediation, arbitration, or a legal decision depending on the contract. A person can notice this when closing statement shows why the small print, body signal, deadline, or incentive cannot be skipped. The purchase contract is the real guide. It explains where the money is held, when it is due, what counts as default, what contingencies apply, and how disputes are handled. Verbal assurances are not enough when the deposit becomes contested. If the escrow instructions are unclear, even honest disagreement can turn the deposit into a dispute. Financing delays can create tension. If a lender requests more documents, the buyer may need an extension before deadlines expire. Waiting until the last moment can put the deposit in danger. Good communication with the agent, lender, and escrow holder protects everyone. The useful comparison is inspection deadline explains why two similar situations can lead to different outcomes. Earnest money is not the same as a down payment. The down payment is the buyer's equity contribution at closing. Earnest money is a contract deposit made earlier. It may become part of the down payment later, but it serves a different purpose while the deal is pending. A missed inspection deadline can turn a refundable deposit into money the seller may be entitled to keep. A practical buyer should ask 3 questions before signing. How much deposit is required? Exactly when can I get it back? And what actions could cause me to lose it? Those answers turn a vague deposit into a clear contract risk. A simple case as appraisal gap shows why the small print, body signal, deadline, or incentive cannot be skipped. Earnest money works best when both sides understand the trade. The seller gets assurance that the buyer is serious. The buyer gets a path to purchase while keeping protections for inspection, financing, and appraisal. The deposit is the pressure point that makes the contract more than a promise. A buyer who removes the financing contingency too early may be risking the deposit if the loan later collapses. A seller may prefer a slightly lower offer with stronger earnest money and clean deadlines over a higher offer that looks uncertain. The deposit does not guarantee closing, but it helps the seller judge whether the buyer is organized, funded, and prepared to follow the contract. Buyers should also confirm wiring instructions carefully. Real estate deposits can attract fraud because money moves quickly and emotions are high. Calling a trusted office number to verify instructions is a small step that can prevent a devastating mistake. Earnest money becomes less frightening when the buyer treats the contract like a schedule. Inspection date, financing date, appraisal date, and closing date should be visible and tracked. The deposit is protected less by hope than by meeting the terms on time. The safest approach is simple. Deposit only what you are prepared to put at risk, track every contingency date, and never assume the money is automatically refundable. In real estate, seriousness is useful, but seriousness should always come with calendar discipline.